call it Bogle's 10 Simple Rules for Investment Success. Maybe if I could just give them to you one at a time, you could comment on each one. And the first one you just mentioned, you alluded to a minute ago when you said, or the rule is, remember reversion to the mean. Could you expand on that one? That seems to be one of your importance.
Well, that's an eternal rule. It's like the law of gravity. What goes up must go down. And in the financial markets, it really works. I have an example in the book. The point of all this, Jim, is don't buy funds on the basis of past performance because it's not going to continue, or it's only the extraordinary case when it's going to continue. So people tend to, as I mentioned earlier, put their money into these big winners, and then down it goes. They pick the high because that's when the fund looks the best. So in that part of my recommendations, recommendation 1, I've taken 8 of the best known and most successful mutual funds of the modern era, and I've charted their return year after year cumulatively against the S&P, the Standard & Poor's 500 index. And every fund looks the same, although all the time periods are different. The fund goes like this, and then it goes like this. This, over and over and over again. And you see this in the big winners of the age, and they go away, their managers leave, even the good managers might get fired, the bad ones retire. There just doesn't seem to be any permanent way to beat the stock market. It's all fads, fashions, particular time periods. You know, when, for example, growth does better than value, you want to put your money in a growth fund, and then value does better than growth. Well, these 10 funds, which I list by name in the book, and 2 of them are Vanguard funds, in fairness. This book is an attempt to be really honest, no matter how painful, and you see that same pattern over and over again. So when you say, I ought to buy this fund, I can tell you where you are on that line, right at the peak. And when the temptation is overwhelming, you put your money in and then are disappointed thereafter. But it's part of the entire financial business. If the market gets quite out of line, stock prices, for example, get quite out of line with intrinsic values, gets high like this and it goes back and reverts to intrinsic value of the stocks. Discounted future cash flow is what we call it. It doesn't have anything to do with stock prices. It has to do with corporate intrinsic values. So, and I should have a nice chart in there to show that kind of mean reversion. It's just truth of the business and how we deceive ourselves because we all think we're smarter than everybody else.
You also, or the second rule is, time is your friend, impulse is your enemy. What do you really mean by time is your friend?
Well, we have the miracle of compound interest working for us. And when you invest over 20 years, 30 years, 40 years, 50 years, for today's young people, an investment lifetime is probably 70 years. Their life expectancy today is, if you're 20, is probably 90. So you're going to be, and then you're going to be investing, you know, after you retire, of course, and presumably that's in your 60s or 70s for some people. And
not you, but
not me. But that curve is just a sweeping curve, and it's the miracle of compounding returns, and it pays off hugely. Albert Einstein called compound interest the greatest financial miracle of all time, or something like that. So take advantage of that, and the only thing that gets you out of it, focus on the long term. Time is your friend. But if you get distracted by the ups and downs, mostly by the downs, people respond much more nervously to downs than they do ebulliently to the ups, although that happens too. But impulse is going to get you in and out of the markets. But think about this. When the market is low, it's low because people like you are really worried. And that's a good time to buy stocks, essentially. There aren't any rules for this. And if you're ebullient and feel very wealthy and want to buy stocks, that's at the high. In other words, if you're discouraged and selling at the low and aggressive in buying at the high, your money isn't going to last very long.
And I guess that's one of the problems, that you have to try to resist the impulse, because we are human, but we're also animals, and we are basically bred to run from fear. So when we see the market goes low, we want to get out, but we have to resist that. Is that correct?
Yes, correct. And if we just didn't pay any attention to these silly swings in the market, which are, I often use this quote from Shakespeare, like a tale told by an idiot, full of sound and fury, signifying nothing. That's what we're glued to our television sets to watch every day. Makes no sense.
Third simple rule for investment success, buy right and hold tight.
Buy right means diversify, diversify, diversify. In an index fund, which is a great way to invest for reasons I've talked about earlier, you at low cost and all that, but you're diversified, so the intricate ins and outs of the market, you know, steel stocks are doing better, or energy stocks are doing better, or healthcare is doing better, or technology is doing better. If you own the whole market, you get your share of all of that. So, but that's the buy right, very diversified, and the hold tight is what we've talked a little bit about, and that is, you know, when you get these periods of adversity and fear and greed, don't do anything.
Well, speaking of greed, another one of your 10 simple rules are to have realistic expectations. And then you talk about the bagel and the donuts and distinguish the two.
Okay. Well, the bagel and the donut is a talk I gave years ago, and I contrasted, like the investment world. The bagel is nutritious, good for you, substantive, while the donut has a certain sweetness, and it kind of breaks up and crumbles when you eat it. And so long-term investing, holding on, the strategy I just described is the bagel, and short-term speculation is the donut. Just a way of visualizing, you know, which you want, which is the best for you in the long run. And sometimes people may think I'd just soon have a couple of donuts, but they're not going to do you any good. With all due respect for the donut makers of America.
All right, and I like your analogies here. Your fifth simple rule is forget the needle, buy the haystack. Now, what do you really mean by that one?
Well, that's the ultimate argument for indexing. Picking stocks or funds, finding that elusive needle that will give you what you think you want in the future is very difficult. We all know the metaphor of finding a needle in a haystack. It means forget it, it's not worth trying. And I would argue the same thing here. Own the haystack means own the entire U.S. stock market or the entire world stock market. Everybody has different ideas about that. And don't do anything once you get the haystack. No more looking for needles. So it's a you know, Don Quixote had it just right.
All right, and another one of your simple rules is to minimize the croupier's take.
Okay, that's a very good parallel to something I mentioned earlier, and that means get costs out of the equation. I mentioned to you the magic of compounding returns over the long term, the mathematical magic of it. The problem we have in our society is that magic, on the record, is overwhelmed by the tyranny of compounding long-term costs. And I gave you that example of 7% gross return, net return, 9% gross return, and it's cost you 70% of your capital over your lifetime. Be aware of that.
But one of your rules is there is no escaping risk. And this is probably a particular problem for people who are older, retired, no longer bringing money in through their work and their labor, have X dollars of a portfolio, maybe Social Security, maybe pension. They don't want to incur risk, but you're saying there is no escaping risk.
Well, the basic argument there is that inflation, which you have no control over, eats away at the value of your dollars. You may think you're being safe if you buy a bank CD or an equivalent instrument, and let's say over 10 years. But that instrument's going to lose 30% of its value conservatively over the next 10 years. You know, they'll have a little bit of interest to offset that. But if the dollar is worth 30%, which is roughly 2.5% per year in inflation, that's gone. You've taken a big risk by, in effect, speculating, for the want of a better word, that the dollar will remain unchanged, and it never has, and I don't think in our lifetimes it ever will. Maybe sometime, but So there's the big risk. So when you look at, say, stocks and bonds, stocks at least have a fighting chance to overcome the ravages of inflation. And the way I look at it, I've got some math behind this, because with a dividend yield of stocks about 2% and potential earnings growth should be in the range of 5%, stocks should give you about 7% over the next 10 years, gross, before cost, before anything. So that's a fairly conservative number, but I think it's realistic. And bonds should probably give you about 2.5. So if you think about inflation, if there's 2.5% inflation and the bond gives you 2.5%, you're doing a break-even investment over the next 10 years. And that's just, you need more than that if you're going to build a retirement fund.
And if you have X dollars and you're getting 0%, and you, even if you're living frugally, you're still reducing the purchasing power, the actual amount of money that you have.
Yeah, and importantly, we live in a way, and I've said this before, in the most difficult time to invest that I've ever seen. And the reason for that is, yes, stocks have more volatility risk. They go up and down, and bonds stay pretty steady from day to day. But you have to take into account not only the risk, but the return. And the return on stocks, I think, is, I'm close to saying destined to, but I won't go that far. I'll say highly likely with a 7% expectation, which could be right or wrong, but it's certainly very likely to be to 2.5% almost certainty for bonds. And actually, I'm being generous to bonds, because the government bond, the 10-year Treasury, is yielding 1.6% today is all. So you got to take a little bit of risk in corporates, and I would frankly take a bigger risk in corporates. But so ask yourself this question, which is riskier for the next 10 years? That bond, which will give you a low return, but probably not very much, or the stocks, which are highly likely to give you a high return, but with volatility along the way. And for that reason, I like the idea of a balanced portfolio, some stocks and some bonds, although you have to think about it a little bit differently today with interest rates at these floor price. Money market funds are basically not even worth buying. The average yield of a money market fund is, I think, 0.2%. People should buy very short-term bond funds, my opinion, high-quality short-term bond funds instead. So there are ways to do it, but you have to look at just not volatility risk, but the entire picture of investment risk to dividend income, risk to your income. If you're giving up a 2.5%, 2% stock yield and getting only 1% from a CD or whatever it might be.
You talk about beware of fighting the last war. What do you mean by that, the last war?
Well, when we tend to look back, we tend to look at the kind of returns, the kind of economic environment we've had. And right now, I mean, I actually wrote quite a bit of this in depth back in the, say mid-60s. And everybody was paralyzed with fear about inflation. We had inflation running at 5 or 6 or 7%. They say, how can I avoid inflation and do this or that or the other thing? And at that point, the inflation stopped. And we had, I don't know the exact number, but probably after that high inflation, we probably had an inflation rate of 2 to 3% is all, maybe 4. So if you're fighting against previous inflation, you're making a tacit assumption that will continue in the future. It doesn't, or usually doesn't, or often doesn't, but we never know when that change is coming. It's kind of complicated. Today, one of the best examples is returns on stocks. The historical return of stocks is 9%. So people say, I want that 9%, so I'll go into stocks. That was the last war. Today, stocks are going to give a future return about 2% less, or maybe more than that, a bigger shortfall. Why is that? It's so obvious. And that is that 9% over 100 years is 4.5% dividend yield on stocks and 4.5% earnings growth. 9 total return from investment. And today the yield on stocks is 2.1%. So forget that extra 2.5%, strike it. And when you go through the math, you'll see that the future return is going to be 6.5% or 7% compared to history. Don't listen to history. It's interesting, and it may rhyme, as Mark Twain said, but it doesn't repeat itself.
Well, speaking of not listening to history, and the short term versus the long term. Another one of your simple rules is the hedgehog beats the fox.
Well, I use that to portray the difference between passive index investing and actively managed fund investing. The hedgehog, the saying from Archilochus, Greek philosopher who just left a few fragments of his work, was the fox knows many things, but the hedgehog knows one great thing. And what the hedgehog knows is that all of this fooling around out there does you no good at all. Own the market. It's another way of saying that. And the fox, oh my, are they smart. They're smarter than all the hedgehogs put together. Go down to Wall Street and talk at all that immensely wealthy brain power that, of course, builds nothing because they're competing with other brain power. I'm not saying brain power is wasted. I'm saying the average brainiac is average compared to the other brainiacs. So they can't win. We know that. So, all the secrets. I've got a tip for you. Buy this, sell that. That's the fox thing, the foxy way to beat the market. Doesn't work.
And the less sexy index funds outperforming the more active brainiac funds.
The index fund, in fact, is an act of extreme boredom. And if you don't peek, another one of my rules that I'm not sure I mentioned in the book, if you don't look, that's in your interest not to look. Why open that 401k statement or your IRA statement every quarter and say either I'm rich or I'm ruined? Just throw it in the wastebasket.
Yeah, Jeremy Siegel says the same thing, that the more often you look, the worse it is. Well, the other thing that brings us to is the last simple rule is stay the course.
Well, we've kind of talked a little bit about that behind the scenes here, and that is once you've set an intelligent asset allocation, taken into account your risk preferences, taken into account your whole financial program. A lot of people, for example, ignore the value of Social Security as a capitalized value for a typical person at the time of their retirement of $400,000 or $500,000. That's your asset. It produces an income stream. You don't have the asset, but you have the income stream with a cost of living hedge. Don't leave Social Security out of your equation when you look at all that. But just get it all right and then don't touch it, except I would argue lean toward raising the bond position as you age. And that's not so easy to do today with bond yields so low. But I probably wouldn't lean quite as far. And when you take into account Social Security, you may be leaning too far already to the fixed income side. For example, if your Social Security is worth $400,000 and you have $400,000 all in stocks, that's a 50-50 equity fixed ratio with one of the great fixed investments of all time has a cost of living clause in it. And the government nicely sends you, as long as they can afford to, a nice check every year. They just raised this year's payments. My wife said, shouldn't we send some of this back? To which I, of course, said we paid for it. But take into account everything. And then don't let yourself get deterred by market changes, by gossip, by CNBC, whatever it might be.